Happy 4th of July, TSP members and all other viewers. This is Scott, and I'm going to give you an analysis of the June 2018 results of the ISM manufacturing report. The ISM is the Institute for Supply Management. It's an organization that does reports on or reviews and surveys on two aspects of our economy. You got the manufacturing and the services sectors. Each of these reports comes out at the beginning of each month. Usually starts with the manufacturing report, which is the one I'm going to talk about here. Why is this important to us as investors? It helps us to know what's really going on with the broader economy. You can really separate a lot of fact from fiction in terms of what this kind of data shows versus what kind of crap you're hearing on the news. I strongly recommend learning about this kind of info and really learning about the fundamentals of everything that makes stock prices move up or downward. I'm here to help with that, and hopefully this will help make a little more sense for you. Okay, this presentation should be quite a bit shorter than the one that I just put out yesterday, I think it was, or day before, about the second quarter results for the S&P 500. This one, it's a lot more cut and dried. These are the areas I'm going to cover. I'm going to start this presentation off with a review of the industry breadth information, which I always find very important. The more you see everybody or every portion doing the same thing, the more likely it is that everybody's going to do the same thing. So right now, ISM's reporting that 17 of the 18 industries are reporting positive growth or expansion. That's a very good sign. And the only industry that did not report positive growth is not even reporting declines. As you see here from this highlighted area, no industry reported a decrease in June compared to May. This bodes very well for stock prices for anybody who any company that falls within the manufacturing sector. The next two slides, I'm going to cover the quotes directly from specific respondents within the sector. Feel free to use your pause button if you need more time to read through this information than I'm going to give you, or even better yet, go to the Institute for Supply Management's own website and go to their report on business section and pull up these reports yourself. And there's a lot of information that you can find in their reports that I'm not even covering here. You're going to see common themes here with some of these responses, though. The common theme mostly centers around supply problems, transportation issues being definitely a portion of that, or lack of truckers. Also, the tariffs are definitely a concern with some of these companies or these respondents as well. All of this is going to lead to inflationary pressures, which I believe is going to encourage the Fed to be more hawkish or aggressive with their rate hike policy. That doesn't mean that I think that's going to be a bad thing for stock prices, but there are definitely concerns here that the Fed will have to deal with. There is a healthy amount of demand, though, as you'll see as well from these. The second page of the quotes from respondents that I couldn't fit within the other page, both are mainly concerned with the tariffs again. We do see another comment there about trucking being tight, though, and requiring advanced planning and increasing costs. So there are some concerns here with slowing growth and higher inflation, but the overall direction, I still expect earnings, corporate earnings and share prices to climb. Just in the future months or quarters, I would just expect to see it slow down more, though. All right, this is the total information that they provide with their numbers. I take the info from their chart and put it into my own and make a year-to-date figure here. The PMI is the Purchasing Manager Index, or the overall figure, basically. It's more like an average of everything else going on within. Um, as you see, there are other areas covering new orders or basically demand growth, production, how uh, how efficiently are the people who are working doing their jobs, employment, how much employment growth there is, supplier deliveries, inventory, customers' inventories, which is two different levels of inventories, um, prices or price growth, I should say, or inflation, and also backlog of orders, new export orders, which is order of the new demand coming from foreign sources, and imports, um, or what kind of demand we're putting on foreign countries. A couple of these I'm not going to really cover in the other in these charts that I'm going to show you in a minute. I'm more concerned about what the overall number, the PMI number is, and what the what the overall demand figures look like, and then what the supply figures look like. You know, and I have them organized so you can kind of get a better visual idea of how they compare to each other. The first chart I'm going to show you here is a comparison of the PMI, or overall sector performance, versus demand specifically. The overall sector growth is represented by the blue bars you see here. Starting from the left to right, you got from January up to June. As you can see from this, we're seeing steady growth throughout the year. Looks pretty consistent too. That's a positive sign for the broader sector as well as the overall economy. When we see expansion, steady, we should also expect to see more increases to corporate earnings, which also begets increases to share prices. On the demand side, it's broken down here into two sides. We have the total figure, which is represented by the orange bars, and the foreign demand, or new export orders, represented by the gray bars. Starting with the total total demand here, you can see that it's outpacing the overall sector performance handily from month to month. Um, Very noticeable difference in how much total demand is present at the moment compared to what the broader sector has actually done. Um, really like to see a little more parity between the overall PMI and the total demand figure, though. The more we see disparity between these two, the more it suggests that there are issues on the supply side of the sector. But healthy demand is still a good thing to have. This question is, can the supply chain keep up with it enough to continue to promote more growth in the future? Um, Going to the foreign demand sources here, you can see from this information that it's also still growing steadily throughout the year. However, it's gone from slightly faster than the overall, than the PMI figure at the beginning of the year, to where the last 2 months it appears to be slightly lower. Not keeping up with the pace of the overall sector. When there's less foreign demand, but total demand is accelerating, or is still strong and accelerating past the overall number, that gives me reason to believe that domestic stocks are a better place to be at the moment than international. Now, that doesn't mean that I think you shouldn't have any money in the international stocks at all, though, or stock funds. It just means that I think that domestic stocks should outperform the foreign stocks. The next slide here is going to cover the comparison of the PMI, or overall figure, which is the same one that I talked about in the last slide, and show you how it relates to the supply aspect of the sector. Once again, the PMI data is shown in the blue bars, which is exactly the same information as you saw in the previous slide. So I'm not going to beat the dead horse. I'm just going to cover the transportation aspect of it and the supply aspect. Transportation is essentially represented by the orange bar, which is really supplier deliveries. As long as transportation's picking up the pace and outperforming the PMI data, that's a good sign. Um, we have a long way to go there as far as that's concerned, though. As you can see from the supply side, um, the upstream inventories, which is represented by the gray bars, uh, it picked up in the first half of the first quarter, but in the most recent quarter, it seems to have stalled out a bit. Not really declining, um, but it's not picking up. It's not picking up any of the lost ground to the PMI number, though. This is going to cause problems with inflation, because, as prices are based on supply versus demand. Now, when there's more demand and less supply, prices go up. When there's more supply and less demand, prices go down. So right now we're seeing information here that hints at more inflation coming in the future quarters. Downstream inventories or customer inventories is represented by the yellow bars here. As you can see, it's just been a steady decline, not incline, but it's going down and going down pretty strongly. That's not a really good thing to see here. One, it does add inflationary pressure. Two, it can get us to the point where inventory levels get critically low, and it can create such long lead times that what demand is there, customers might either get apathetic and just give up on what they're trying to buy, and just which contributes to stalling of business growth, corporate earnings growth, and stock price growth. And at the same time, they might also decide to look for alternatives. If I can't get what I need, then maybe I'll try some other source. That other source could be foreign sources or some other option that doesn't require transportation, for all we know. Uh, so we do have these concerns on the supply side. The last chart I'm going to show you here is a comparison of PMI versus price growth. Price growth, of course, means inflation or deflation. At the moment, and this PMI number is still the same information you saw in the previous charts, and no need to cover it again. But the C price growth has been strong all year long, and continues to be very strong. This puts a lot of inflationary pressure on us. And of course, as I mentioned earlier, stronger inflation is going to lead to a more hawkish or aggressive FOMC as far as rate policy is concerned. That's all the information I really wanted to cover as far as showing you charts and visualizations of what's going on concerned. There are a couple of areas that I did not cover in charts or anything like that, which primarily was like production and employment data. I don't think that is so much concern to the general public or average retail investor as knowing what supply and demand data actually looks like, as well as the transportation issues. So uh, I'm going to close this by saying that I do think that demand is very healthy right now, and there are signs of at least the transportation sector trying to pick up the pace and keep up with that demand. However, supplies are definitely a concern. I do expect to see more corporate earnings growth and share price growth in the coming quarters, but supply concerns here can definitely be a cause for concern with what kind of growth we'll see further down the road. It doesn't mean that growth is just going to stall out completely and start turning negative and start the next recession. It just means that a slowdown is likely to occur if the supply side doesn't manage, isn't able to pick up the pace and keep up with demand. Um, Also, as I mentioned earlier, I think domestic stocks are a better place to be than international stocks based on this information. Also, I'll add that S&P 500 companies are the large companies, and they have greater international exposure than the smaller domestic companies. And since there are signs of slowing down of demand on the domestic side, I think it will impact the S&P 500 more than it will the broader domestic economy. For those of you who follow me on TSP, the S&P 500 is what the C fund follows. Uh, the, the the broader domestic economy is followed by the S fund. S fund actually follows an index which is ran by Dow Jones. It's not the Dow Jones Industrial Average though. It's Dow Jones Industrial Average is just 30 large cap companies that are also part of the S&P 500. The S fund in TSP only covers an index that's managed by Dow Jones, the company, and has over 4,000 companies in it of all market cap sizes, but it excludes specifically the 500 companies that are in the S&P 500, which also means that it excludes the Dow Jones Industrial Average components. Okay, now based on that, I do expect both domestic and international stocks to see at least some kind of share price growth over the coming months and quarters. However, I'm definitely going to maintain my position that you should bias your posture toward the smaller domestic stocks, and followed by the large domestics or the S&P 500 stocks. But don't discount completely the international stocks. There is still some growth expected there, and from what I've seen from EFA, which is the ETF that follows the EAFE index, which is another stock index that is put out by MSCI, which is yet another company. For those of you who don't know, EAFE it stands for Europe, Australasia, and Far East. Basically, it covers all the developed world economies of those regions. Basically, Europe, Asia, and Australia, for the most part. There is still some growth there, though. Also, for those of you who are in TSP, the I fund, we've seen that I think it had about a negative 3% performance so far this year at the end of June. But in reality, I don't see impressions from these ISM reports that give me reason to believe that it really should be in the negative. So if you're playing a short-term game, there might be a possibility there for you to take advantage of as far as the I fund or EFA or developed world international stocks are concerned. My long-term position is still going to be biased toward the domestic stuff. That's all I have for now. Please let me know what you think. If you have questions or comments, any inputs you want to give, I highly encourage you to put them in the comments section of this here on YouTube, or if you're in my TSP group on Facebook, let's discuss it in there. Also, if you're not in my TSP group on Facebook, I'm going to give you a caveat that we only allow people, TSP participants into the group. And also, those of you, if you're not in TSP, if you are in TSP and you're not in the group, we are trying to keep the growth rate of that group under good control, so we don't get inundated with a lot of the same questions over and over and over. So please, if you do decide you want to try to join that group and you are a TSP participant, find out who you know who's already in the group and talk to them. I really want to make sure you can get the help you can, both personally from people you work with first, or before you come into the group and ask a whole bunch of questions that have probably been asked and answered a whole bunch of times in the recent past. All right, that's all I have. Thank you for watching.